Welcome back to the Money with Mission podcast. I'm excited. I'm usually excited about my podcast guests because I don't know if you guys pick up on it, but I just like talking to people and I end up having conversations like I would if I'm sitting at coffee, just learning about their lives and what they do and why they do it and who they are. So today we had a good time with this one. Yes, I'm doing this intro after I already talked to her, but it's the way it goes. This is Felecia, host of Money with Mission podcast. We are supported by Money with Mission, whose vision and mission are that every woman have the financial ability to walk away from any job or relationship that is not in her best interest. And before I get into Laura's bio, we are making some changes around here. So stay tuned for that. Things are going to look a little bit different. Our guests are not going to be that much different because it's still going to be people I want to talk to and hopefully you want to hear from. So that's what's going on with Money with Mission. And today we have Laura Phillips. Talking to Laura about reverse mortgages, which I know if anybody watches TV, commercial TV, or even if you have YouTube TV like I do, streaming, they get commercials on there. But anyway, you hear from Tom Selleck about reverse mortgages, and that's always been interesting to me because it always seems scammy. But we'll see. Let's see what Laura has to talk about it. She is a licensed reversed mortgage specialist. Yes, they do have licenses for that, with a mission to guide people through the entire HECM/reverse loan process so they feel confident about the options available for their next 30-year financial strategy, from helping real estate professionals, customers, and financial advisors to navigate home financing. She helps customers find mortgage solutions that work for them. Laura's 25 plus years of experience in real estate have taught her that it is not just a person's house, it's their home, and it's one of the most significant financial commitments a person will make in their lifetime. She helps people devise strategies to enjoy their best years in their family homes. She serves all of Colorado. She also does loans in Arizona, California, and I think she said Florida, and specializes in the standard FHA, HECM, which she explains what all that is, and proprietary portfolio jumbo reverse loans. As a broker, she works with several primary reverse lenders, providing loans to enhance a client's cash flow, preserving retirement assets, or purchasing a home that meets future needs. She's been married for 35 plus years, is a mother of two amazing daughters. We do have that in common. We also love dogs. She has lived in many states, all west of the Mississippi, and a couple of overseas, what we do get into also. Again, she lives in Colorado. I had fun talking to Laura. I think you'll enjoy this conversation. I learned a lot. There's a lot of strategy in our home equity besides just that line of credit. So enjoy the show and stay tuned for the changes that are coming. By the way, if you haven't subscribed, you're here. Just do it. Okay. If you're on YouTube, please subscribe. If you're just listening on audio, please subscribe. If you just do it. If you don't want to do it, tell me why. Tell me what it is about the show that makes you hesitate to subscribe, and just let me know. And I'll be happy to see if we can make those changes that would get you into our world. Take care. Have a great rest of your week and enjoy the conversation with Laura.
Be the change you want to see. Make a difference by giving your money a purpose, a mission to do good. Welcome to Money with Mission, where we show you how to create passive income so that you have options for how to work and how to live your life while leaving a legacy of positive social impact.
Welcome back to Money with Mission. We are going to talk to Laura Phillips, like we talked about before. Welcome to the show, Laura.
Thank you. Thank you so much, Felicia. I appreciate being here.
Laura is joining us from Colorado, just outside of Denver. She says it's sunny there. I'm in Oklahoma. I think it's cloudy out here today, but it rained yesterday. I'm ready for spring, and it looks like the plants are starting to come up over here. How's it looking there?
I think the snow finally melted on my north side. It's a mud field. My front yard looks a little green, and we actually are going into our snowiest seasons, March, April, and May. They will give us a foot, and then the sun will be out the next day and it melts. So we could use a little moisture down here.
That's your rain.
My rain. It doesn't rain much in Colorado, so that's it. We count those snowflakes.
Okay. Got it. I like Colorado. I haven't been there in a long time.
Okay.
Let's get into this, Laura. I understand. We know that you're a reverse mortgage specialist. But before we get into talking about reverse mortgages, which is just so you guys know, I had Laura on the show because I'm like, you hear all the commercials. You got Tom Selleck talking on TV about reverse mortgage. Like, is this real or is this some kind of scam? So now we're going to learn the real deal about it. But let's talk about your money story. How did you learn about money, or what did you learn about money? And can you talk through your transition phases to where you are today in money?
Absolutely. I grew up in a Texas oil patch. My dad was a geologist. We moved around a lot. And for some reason, they really didn't teach me much about money, to be very honest with you. I didn't even know how to balance a checkbook. They went halfway around the world to Iran. I went off to college. I had no clue what I was doing. There were a lot of mistakes made along the way. As I grew in my adulthood, I guess is the best way to put that, as I got out there more in my adulthood, I gravitated towards understanding how numbers flow, how they flow together, not flow, but how they flow together. And it made sense to me when I was talking to somebody. I'm not a financial planner, but I could see their finances and the numbers flowing back and forth and what was a good way to make a loan work. So I actually got started in money, not as a financial advisor, but as a mortgage lender. I've been a mortgage lender for 30 odd plus years. I decided about 7, 8 years ago to put my flag 100% in reverse mortgages because I felt like it was a very underserved market that really, even though it has a horrible reputation and was well earned at one point in its lifetime, it is such a great product. And I really think that all seniors should look at it at some point in their life to see if it could help them in their situation. So again, for me, watching those numbers flow and how they flow and where the needs are in everybody's lives, like you need to pay insurance, you need to pay doctor bills. How does all of that come together so that you can still afford to live in your home? So
you said you made mistakes. Let's talk about what's the biggest financial mistake you're willing to talk about.
oh dear.
And what did you learn from it? How did you come out of it? Let's talk about that, because I think, well, that's one of the things in money. We talk about making money. That's about all we talk about in life, and saving money and putting away for retirement. But people make financial mistakes every day, but we never talk about them.
I think for me, it was learning how to balance a checkbook. As embarrassing as that is to say, was never taught it. It was the bank of dad, or basically. And when my parents went overseas, my favorite story, my parents are passed now, would still probably roll over in their graves if they heard me say it, was that I got a bill for my mother's dresses from Neiman Marcus before they left. We were living in Texas at the time, $450. So I write out a check and send it, not thinking to look at the bank account that I had to cover that bill. Of course, it didn't fly at all. And so then I get screaming letters from everybody, including my parents that are halfway around the world. So for me to learn and be a better manager of how the money comes in, where does it flow? How does it flow? It's like a river. I mean, money is like a river. It comes in and it flows out. And you can put it in different pockets or different buckets, however you want to look at that. But it's still moving. And how do I control that move so that it serves me the best? So that's my biggest mistake.
$150?
It was $450.
$450?
4 dresses.
I'm going to come back to that, but I want to really focus on and just make sure everybody heard about money moves. She didn't talk about money being in a pond that just sits there and grows mosquitoes and eats you. No, money flows. It's got to come in, it's got to go out. That's the way it works the best. And the best, you guys have heard me talk, the best money going out is it's going to work for you. Like, send it out the door to go to work, and then let it come on back in with some babies and some friends, and then send them out to work. The more money you got working for you, the less you actually have to work for money. So
Absolutely.
remember the flow. Money sitting in the bank is not flowing for you. That's flowing for somebody else. I just had to say that. Okay. So you had your $450 mistake. You wrote a check when there wasn't $450 to cover it. And it sounds like it was from there that you realized that this flow thing, it's like, I got to, number one, look and make sure how much money I have before I go spend it. And then connect that for me from there to the flow.
Well, I look at it like the money comes in. And to this day, I will fully admit I'm not a great balancing person on my checkbook.
Okay.
But I'm certainly much more aware of what comes in and what needs to go out.
Yes.
Is there a reserve, the rainy day reserve that
Mhm.
we're all been taught to have? Yes, there's one there. I need to be careful to not dip into that
Mhm.
unless it's quote a rainy day or it needs to be used. So that flow for me is I have obligations and I need to take care of those obligations. And is my money working for me? I would say that I probably use my equity in my houses where I'm having that money work for me
Uh-huh.
rather than my actually putting it into a savings account for stocks. I do have some stocks. That's a market that, again, I'm not fully up. I'm not a financial planner. So, I don't know that we can wear all the hats that would need to understand that. So for me, following stocks is a mystery. Like it's like the wizard behind the curtain that actually is wanting back there.
I agree.
So that's where my money works, other than I look at my equity in my home as a way to also make money work for me. As it stands right now, most equity that everybody has in their home is that stagnant pound. It's just there. It doesn't really earn any interest. It doesn't lose any interest. It goes up and down based on what the market value of your home is. Can you make that work for you? I truly believe you can. Yes.
I agree 100%. And I 100% agree. Most people have equity in their home or in a lot of things. The home is our biggest source of equity, I think, maybe. And we don't do anything with it. Oh, you were talking about that stocks aren't your thing. You talked about your thing is mortgages, and that I want my docs out there, the lawyers out there. We do things as specialists, right? You don't want to go to a corporate attorney. You don't want to take a criminal attorney to do your corporate stuff. You don't want a neurosurgeon to do your gallbladder operation. I mean, we probably could figure it out, but is that what you really want? You don't want them doing, you don't want the urologist doing your heart surgery. No, you want your specialist, and think that very same way about your money. When you decide, if you decide you want to do stocks, you want somebody who knows stocks helping you know what to invest in.
Absolutely. I fully agree.
Perfect. Okay, good. I just want to make sure everybody heard that specialists are important in everything, including your money. And talking about it, you don't need to know everything. You just need to know a little bit about everything, just like in medicine, a little bit about most things, enough to know it's not your thing, right? You
Right.
know,
And it's not my specialty. You're right.
not what I do. Let me get you to somebody who does that.
Mhm.
So that's really good. Really good. Okay. I've heard about reverse mortgages in relation to retirement. And I define retirement to all the folks who've heard me say it before as doing what you want, when you want, with whom you want. How is retirement defined in your world and what you're talking about?
I actually agree with what you said. Doing what you want when you want and with the people that you want to do it with. I fully agree that. I think I would add a caveat is to make sure that you could actually fund that.
Yes.
We
Yes.
can
100%.
all want to take a cruise around the world, but if we don't have the funding for it, it doesn't really get us very far, or the frustration level is really high.
Yes.
So for me, retirement in the eyes of a reverse mortgage and doing it is being 62 or older to be able to get one. And that is the standard HUD reverse product, which is called a HECM, which is the Home Equity Mortgage Conversion, which sounds like you're coughing up something horrible from cold. Yeah, really? But it's a proprietary jumbo product that goes down to 50. And I see people now using it to increase the quality of their life or being able to leave legacies to their children or their charities of their choice. And so it's no longer a loan because it is just a loan for those that are in desperate need of funds. Obviously, if that's where you are, then by all means, go out and look and check into it. But there are so many great uses for it now.
So just when you said that about funding things, and I mean, I know a lot of people that I talk to talk about a home equity line of credit.
Right.
What's the difference?
Well, home equity line of credit means that you go to a bank, you get it, and they're usually from a bank, by the way. I mean, very rarely am I able to actually offer one as a mortgage lender. It's really a banking facility item. You'll get it, and it usually has a term of 10 years or so for a draw, and then a payback for 20 years. It has a payback. That's the biggest key. A HECM, or home equity conversion, is also a line of credit. However, you do not have to pay it back if you don't want to. So it's the only program out there that I know that lets you look at your finances and say, do I want to pay it back or not? If I pay it back, it just gives me more of that line of credit further down the road, but it's not a requirement. So they're very similar, with the biggest piece being whether you pay it back or not. Right.
Payback. And your minimum age to do a reverse mortgage is a HECM. I think reverse mortgage has at least, I don't know why it doesn't roll off my tongue well. It makes me feel a little, I don't know, dirty. I'm just going to say it. But the HECM
Okay.
is your minimum age is 50
With a
for some
proprietary,
products.
right, with a proprietary loan. And then 62 for the government product. So there are two products out there. One
Okay.
is the government product, which is run by HUD and managed by HUD. It's
Okay.
really underneath the FHA division. The other is a proprietary, and it would go up for home values that are in the millions, and that actually is a loan amount that goes up to $4 million. So it takes care of those lucky people that have homes in that price range that don't necessarily have to have it for funds to make it ends meet, but want to make sure that they leave legacies.
Okay. So do you have to have $1 million of equity in your home, or your home has to be valued at least $1 million?
For the proprietary loan, you need to, well, for all of them, you need to have at least 60% value in your home, of your equity in your home. Much less than that, it would look like mostly you would have to come to the table with money. Now, in some cases, that might work out. It just depends on everybody's individual with their finances. It's not, in any case, one size fits all. We all are very, very unique in our finances. So if you have to come to the closing table with some funds, then does it make sense? Does it mean that we're getting rid of a current mortgage payment and a few $1,000s to the closing table would relieve that pressure? Then that might make a tremendous amount of sense to that family. To someone else, it might not.
Okay. Talk about that a little bit more, about bringing money to the table. Let's talk about the proprietary one, where you can, I think many of our listeners are 50 or less than 62. So they're in this 50, say they're 50s, they bought their property, they bought their home 15 years ago, and the price has really gone up. They got a lot of equity in it now that's just sitting.
Yeah, it is.
And so
It's
now
not really working for you.
it's not working for you, right?
It really is not working for you at all.
Okay.
So that proprietary loan starts, I don't know, you can go down as $350, $350,000. I'm sorry, I drop off zeros because I work with big digits all the time. It's easier for me to just get to the core number. I have seen loans in the proprietary market be down as low as $350,000. That doesn't mean the house it's worth obviously 65% more than that or 60% more than that. So we're probably talking about a house maybe, I don't know, 700,000 or so, but I'm trying to do some rough numbers in my head. So what do you want to do with your money? What is it you want to do with your money? Do you want to leave it to a charity, an organization? Do you want to help a grandchild go to college? What is it you want to do with your funds that you're just sitting there? Obviously, you need to take care of yourself first. Whatever you do, you need to take care of yourself first before you go out and say, now I can divvy these funds out. But you have a lot of opportunity. People have a lot of opportunities too, because of such tremendous value in their home going up in the last 10 to 15 years, to help their families, to help themselves, to help organizations that they're interested in.
So when I think about it, you guys know how my mind works, I think. If you've listened to me a little bit, you know how my mind works. I'm thinking, I've got this equity sitting in my property. I can get a home equity line of credit, and I am over 50. I know I don't look it, but I am. Okay. Home equity line of credit or a reverse mortgage. And I choose a reverse mortgage because I don't want to have to pay it back. But what I'm thinking I'm going to do with that cash is invest it in something else rather than have it sitting in my pond. I'm going to get that money moving for me, sending it out to work to bring stuff back. And again, that work is a lot of different things for people. It can be to bring money back to you, or it could be to invest it in something where the investment's going to help children do something, to get children educated. So that's an investment. And again, I'm going to go back to my thing about everything's an investment. Whether you're giving, air quotes, giving to charity, it's an investment in something. So I really want people to think about using your money as investments, whether it's a return on your investment as cash or return on your investment in something else that's valuable to you.
Correct. Yeah.
Okay. So you were talking about you can leave it, you can have it and have a kid go to college, you can all these different things,
Mhm.
and you can choose to pay it back or not pay it back. And why would you choose to pay it back if you don't have to?
Right. In all of my years of doing this product, I've only had one person choose to pay it back.
Okay.
It didn't make sense to me, but I think she had spent so much time alive. It was a husband and wife. He was a college professor, pretty much in his world of professorhood.
Okay. Yeah.
He didn't really respond a lot to or dialogue at all when I was working with him. But I think she had spent most of her time managing the family's funds. And to her, it was you have to make a payment.
Yeah.
And they had the funds to do that. There was certainly no reason for that. I can't remember the exact reason on why we did it. It wasn't to eliminate the mortgage because what she was paying back was similar to that. So I don't believe it was actually to reimburse the mortgage, but I do believe it was to put the line of credit on so that if they needed funds in the future, that they could have it. So I
Have the
believe her
money.
idea was if I pay it back the interest each month that I'm using on the loan, then I will still have this larger pot whenever I need to have it. It is a loan that is going to come with it. I don't want to hyperventilate when I say this. It's a negative amortization loan. So that balance is going to grow each
Okay.
month. And
Okay.
it's not a bad thing. No, it's not a bad thing. It's just that you need to understand how do you make that tool work for you. In her particular mind, she wanted to keep that pot of about $600,000 at $600,000. She didn't want the interest to eat into it, so that when she needed to tap into it, it was there. They had the funds to make the mortgage payment on it, and she could choose to make it one month and not make it the next. She had those options and that flexibility. So that kept that balance from growing by her doing that. I would say all the other people I work with have always or white glasses, so my hair doesn't fall down on my face. All those other people are like, why would we ever pay it back? We're not interested in doing that. We want to get rid of a mortgage. We don't want that any longer. We're okay with the house balance, the value of a mortgage going higher than the house value. If you live in the house till you're 100 years old, there's a good chance with a reverse mortgage, the house will be upside down. In other words, the house will be worth less than the mortgage will be. However, I haven't talked to anybody that felt like they were going to get to 100, and that was going to be a huge concern for them. And they felt like the money was working in better places than just sitting there in the home.
So you brought up couple of things, and the last one that I got in my head is that it comes upside down. So
Right.
you die, and your heirs are left with a house that's not worth as much as is owed on the loan.
Correct.
What do they do?
Well, it's the elephant in the room. I always address that whenever I talk to a client. We have an elephant in the room. Let's talk about it right away. It's called mortgage insurance. Now, when we first were out buying houses, most of us probably came with 3% down, 5% down, bought a house, and we had mortgage insurance, MIP, mortgage insurance, and we paid it to the lender. That particular mortgage insurance was to protect the lender. Should you ever not be able to make the mortgage in default on it, it was protecting the lender. But FHA still has you do mortgage insurance on a reverse mortgage loan, but it's to protect you and your heirs. So should the house go upside down, I hope we never see that market back in 2010, 11, and 12, where we lost so much in value in our homes. But if we ever saw that again, and that affected the house that mom and dad were in, FHA, no lender, they're never going to come back and say you won't owe more money. Whatever happens, they just get the keys, the house, and they deal with it. Now, lenders aren't in the business to own homes. They're not in the real estate business.
Right.
That's why they look at you can only have maybe 40% of your equity, is to try to prevent that from happening. And that actually happened under President Trump in his first term with us. He lowered how much we were allowed to tap of our equity, lowering it down to about 45%.
Okay.
Keep that from happening. So that there was money still available for the family at the end, or at the end of whatever it was, that there was still some equity left over that the family could have. Now, if there's equity in the house, the family can do a couple of different things. They can sell it, pay off the reverse mortgage, and recoup the funds. It would never make sense in my mind for them to give the keys, if there's equity in the home, to the lender. Only
Right.
time that would ever make sense to me is when the house is worth less than the loan. So that's really how the heirs could handle that. Now, that mortgage insurance is expensive. These loans are really designed to be the last loans that you ever get.
Okay.
Within reason, let's put it that way, within reason.
Okay.
And so that mortgage insurance is to help protect you and your heirs. And that's really what it's there to do.
And when you say it's expensive, percentage of what you're getting, how much is it? How
That's
much?
2.5% of the loan amount. It's not cheap. So what I'm saying is we had a dip in our interest rates that went down to those great 3% numbers that we would love to see again, right? All of us would think this would be a wonderful environment if we had those again, at least from the interest rate of the house.
Right.
So we did, if you got a loan at that interest rate, that's great. Now the loans are more at 6 to 7%. So now if you get this loan at 6 to 7% and something happens in the future, we're not really asking for another COVID. We're not very asking for another collapse of the world, or certainly our real estate environment. But if the rates were to go down, I would highly recommend the senior, the person, talk to a professional again, talk to a mortgage professional. In particular, talk to somebody who does reverse mortgages and see if it makes sense to refinance at that point and get that lower interest rate. You'll get a little bit more funds to yourself because you've had more equity built up, but you're also going to get a lower interest rate, which means it's slower at actually, what's the right word? It's slower at growing that loan balance because the interest rate's lower.
Okay. So just to go back to it's a negative amortization. And so I'm not paying anything. I've got $100,000 I'm trying to make it easy. $100,000 loan on my house at 10%. So every year it goes up 10%. So next year my loan or what I owe is 110,000.
Basic, simple math, yes. Simple math, yes.
Okay. Basic, yeah. Let's not make it complicated. We have to put out calculators and amortization crap. Then
Oh my goodness, I have to do them on a computer. They're so complicated.
exactly. No, but basic. That's going up. If you can refinance it now, say your loan is at that higher rate, you've had it for 5 years, so what's that, 150,000 on basic math,
Correct, something like that.
and now your house value interest rates have dropped to 5%, and you want to refinance it, so you refinance the whole thing plus the increased equity.
Right. It's just like a regular refinance of a loan. So you're going to look at the new value. Keep in mind, in 5 years, your house has gone up. I mean, we look at an average of about 4% a year. Now, lots of areas in the last 5 years have seen tremendous double-digit appreciation. I'm not sure we're going to see that again. I think that we're probably going to go back to more standard. And right now, I work with a 4%. It's requirement. I don't try to overinflate when I think somebody's home is going to appreciate that. So we look at a 4%. Well, so your house went from $200,000 to a $900,000 example. Let's say the house was $200,000. 5 years out, 4% is probably close to 275, somewhere in that range.
You
will refinance at that point, pay off the 150, lower interest rate, get some more cash to be able to use, and move forward. You bet. Right now, it doesn't make sense to do refinances, but when we saw those interest rates in the 3s and 4s, it was wildfire, which was true for all markets at that point, for people doing refinancing. Absolutely. And it makes sense.
And the interest rate on these loans is similar to the interest rate on a loan you'd get if you were buying a property?
Very much so, yes. Both the proprietary and the HUD, or for FHA product, the HECM product, have a fixed rate. And they have a line of credit, which is just like the line of credit you would go and get from a bank, except that, again, it doesn't have requiring the payment. So that line of credit works with a margin and a index. So you take a margin of, let's say, 1.5, 2%, somewhere in that range, whatever works to make your file work. And you add it to the CMT, the constant maturity treasury. Now, you can look that number up in many, many different ways. Online. And then you're going to add your, let's say, 2% to it, and that's going to be your interest rate. So probably right now, if we add 2% to CMT, we're probably looking at 5-ish.
Okay.
Again, right off the top of my head, no sheets in front of me, anything like that.
Yeah.
But a fixed rate is probably coming in at about 6.5. Now, why would you look at a 6.5 fixed rate versus a line of credit? Well, this fixed rate loan, and this is true for both the proprietary and for the HUD, the HECM loan, tends to leave more money on the table in the house, leaves more equity in the home. So if you don't have a huge need to take a lot out and you look future down the road, and hopefully your mortgage person is also helping you look down the road to make sure that there are enough funds there, then that's a perfect loan. It's fixed, it never changes. It's always going to be at 6.5%. However, right now, about 95% of all loans are lines of credit. These people get a little bit more, and that line of credit, which is not sure with the bank, grows each year. So if you're not using it, this thing, your example of $100,000, if you're not going to use it, it's just going to sit there in that pot, and it was at a 10% interest rate, as your example, because that's a good one for math. Next year, it's $110,000 that you have access to.
Oh, I see.
So that's what has been very, very popular about using that line of credit.
Okay.
It can grow for you,
Okay.
which doesn't happen with the banks.
So, okay, a couple of things. With the reverse mortgage, one of them, when you take it, do you have to take all the money at one time, or can you piecemeal it out?
With the line of credit, you can take it as piecemealed out. I've had people close on those loans and never take any funds at the closing table.
Okay.
You have access to it within 2 weeks of that loan closing. It has to go through a servicing department, get set up. But after that, you can access it through a phone call or on the computer to get those money, and that money is sent directly to your bank. With the fixed rate, it is a lump sum. You take it all at one time.
So that will be another reason to me to take it as the line of credit. I mean, you do have the risk, the interest rate risk, but if you're using it, but you don't have to pay it back necessarily, right?
No.
Even the line of credit, you're not paying it back unless you want to. Okay. Okay. Interesting.
So I'll give you a great example. It's not in my area. It actually comes from a training class up in Connecticut. The family had some great stock in Apple, and they wanted to keep it and give it as their legacy to their children. They
Okay.
put a line of credit on their home, and they never used it because, again, they were financially secure enough to be able to make their mortgage payments and cover any medical issues that were coming up living in the house.
Okay.
That line of credit, after 15 years, grew to be over $1 million. So, and they passed at that point. The kids get the stock. They can take the line of credit out just before they pass and give their children $1 million. They don't care if the house went upside down because the kids don't want the house.
Right.
The funds are really what's going to help, in their mind, the children. So they had a much larger, like I said, much larger inheritance to be able to provide, and not using that line of credit that they didn't need. And its growth factor can be phenomenal.
So I missed the Apple part. How did the Apple stock come into it?
They had Apple stock that they didn't want to sell.
Okay. All right.
Wanted to keep the Apple stock and make that part. Financial advisors, we have assets with them. And eventually the thought is, well, we'll just spend down the assets, and that's how you fund your retirement in your later years. But in this particular case, they did not want to spend that one down. They wanted to keep that one separate. And we were okay to spend the other ones down, but that stock to them was more like gold than anything.
Got it. So if your house is paid off, you can still do this reverse mortgage, yes?
Absolutely.
And they just take whatever the value by comps or however it's decided what the value of your property is to determine what your loan amount could be.
Correct.
Okay. Personal information, you guys. My dad
Fair enough.
lives in his house. It's paid for. And we're thinking it may be a $500,000 house.
Okay.
He has plenty of money. He doesn't need the money. He can do what he needs to do.
Mhm.
So if he did what these other folks did and take out let's take $300,000 reverse mortgage line of credit at whatever you said, whatever CMT, a CMP, what's
Yeah, that's the index that we're working with, correct?
a CMT plus whatever the percentage is,
Mhm.
then over time that could grow.
It does.
So we have then, as a daughter, I have three sisters. So the four of us then could divide up whatever that loan amount is as inheritance.
Mhm.
Who owns the property?
You always own the property. You're always entitled to your property. The bank doesn't own it, never has, never will. There are only two ways you can lose the property. If you don't pay your property taxes and maintain it and say that you're living in it. So it has to be your primary home.
Okay.
You can go to a nursing home for rehab. You could take a wonderful trip to Africa for 6 months and see whatever in Africa, all the big five. You can see the elephants and then giraffes and the rhinoceroses.
Yeah.
That's all okay. You just have to live in the home for a certain amount of time. So I tell people you should probably be in the home for at least a week or two. I have families that go to Arizona from Colorado because winter's harsh. They go to Arizona, so they're snowbirds, and they live down there for 6 months out of the year. They come back here to Colorado to live during our nicer weather. Not a problem with a reverse mortgage. You want to let your servicer know that you're going to be in Arizona or you're traveling for the next 6 months, but you'll fill out a form once a year that says that this is your primary home and that you are still continuing to live in it.
So, okay, thank you. And so you still own the property. My dad passes away.
Right.
And now we have this house and we have this loan. And tell me what happens next.
So you have the house and you have the loan. So if you don't use the loan, so you choose not to cash that loan out, then whatever the line of credit is will go away. It goes away at their passing.
Okay.
So if you don't take the line of credit out prior to the death of your dad, in this particular example, then it's just equity in the home. Now, does the equity grow as fast as the line of credit? I don't think the equity grows at 6 and 7%. That's the thing that financial advisors are finding very interesting about this product, is that line of credit grows better than the bank can give you on interest in a savings or a CD. And certainly it's working better for you, even just sitting in as a line of credit, than it is sitting in the equity in the home. So your dad, if that particular case, would need to pull it out, divvy it up at that time. It's still going to keep the house probably right-sided. Again, the whole idea behind these loans is to not develop them into being upside down. It's just the inheritance from the house piece is going to be less because
Got it.
what it leaves as a loan.
But it would still be my responsibility to sell the property.
Mm-hmm.
And
Right.
even if you pulled just the interest that you've made over that, it's more than probably what the appreciation on the property is over the same time period. Is that?
Absolutely. Again, we work with a nationwide average of 4%. And to be honest with you, I think we're probably headed back into the single digits. Colorado saw 10% plus for several years in a row. Not all Colorado, but certainly the Front Range did.
We're heading back into the single digits for what?
For appreciation on your home.
Okay.
I think we're going to go back to single digits.
Yes.
I'm seeing the talking heads, that's what I call them, the talking heads out there, are saying that we'll probably see a 2 to 4% appreciation this year. I don't think anybody really knows. I think there's a lot of what ifs out there.
Yeah. And real estate, again, you guys remember, is local. This is a nationwide average we're talking about, it, whatever the appreciation is, because I'm sure somebody's living in some town where the appreciation is 10% and hadn't gone away because everybody wants to live here and houses aren't. So real estate is very, very, very local, and not just, it's like neighborhood local, not even city local. So
very much neighborhood local. Yeah.
Keep that in mind. This is very interesting. So we're talking about death. Like, my dad's going to live forever, of course.
Good for him.
Happy birthday, Dad, coming up. Anyway, he's going to be 90 and he is still completely doing his life. So
large, that's awesome. I'm glad to hear it.
Yes. So, I mean, yes, everybody dies and many people get a divorce. So you've built your life with your partner. You bought this house. You were happy, 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 and then you're not. And you decide that this isn't going to work anymore. But we have this house. How does the reverse mortgage play into that?
It depends on what one of the spouses wants to do. Typically, one spouse doesn't want anything to do with the house anymore. They're done. And then the other spouse, and it doesn't really matter if it's male or female, but the other spouse really has a lot of vested into the home and they want to stay and keep it.
Okay.
So again, not a divorce attorney, but I do know that usually assets are looked at. And the house is an asset.
Right.
And most times they're trying to split those things equitably as best they can. And the house goes in the column of assets along with your stock and your savings and your 401ks. All of that adds up into assets. And then we start going, okay, we're going to do 50% here, 50% there, however that works. So let's say that the one party really, really wants to stay in the home. They can refinance the home with a reverse mortgage and very possibly pay out the other party. Both of them owned it together, pay the other party their 50% and keep the home. So that's a great way to look at a divorce and a reverse mortgage.
Okay. And again, that's for someone as the proprietary product, you have to be at least 50 years old.
Yep.
Stud product, 62. So
Correct. Yeah.
hang in there until you're at least 50.
That's right. Hang in there. Come on. Figure it out. Yeah, but I've seen it also used because they had a great 401k and they didn't want to split the 401k with the surviving spouse that they were a little irritated with now.
Yeah.
Again, they were happy to use a reverse mortgage, stay in the home, and instead of be able to split it between the amount that they owed and keeping their 401k.
401k.
I mean, again, money flows, and that's exactly what it does. And you just have to be, okay, well, here's a rock, it's a bump, but where does it go if it hits that bump, and how does it flow around that? So that's exactly how I work with attorneys. I look at the party that they've asked me to look at and whether they can afford a home. If they were to buy it and pay mortgages, can they afford it and do a reverse mortgage? And then if they do, how much funds they're going to have to allow them to stay and how much funds they might need to have to pay off the other's party. So
Okay.
I do work hand in hand with the divorce attorneys to come to those numbers.
I think that's a really, really creative way. And that's the money, besides flowing, you need creativity sometimes to get it to do what you need it to do. But that's a very creative way to get things taken care of. In a divorce situation that can be contentious, let's hope most of the time we're getting divorced, like, yeah, we already got the contention out of the way. We just don't want to be together anymore, and let's just make it happen. I like that. I like that. Very interesting. Okay, what else were we going to talk about? Getting the IRS off your back.
Some people, this is an interesting one. It's not quite getting them off your back. So we'll go back to you have assets with your financial advisor, and you had to use some assets last year. We're just in taxing. We had to use them last year. And we sold, I don't know, $50,000 in stock to be able to fund our life, fund our situation.
Okay.
Guess what? You probably have to pay taxes on that sale of those assets, right?
Yep.
Well, instead of doing that, how about if you looked at a reverse mortgage and took it out of the house and took the $50,000 out of the house versus selling the asset? And then in the good years, your assets pay you. In the lean years, when the market's not doing as well, you use the reverse mortgage so that you're not selling those assets and thus not paying the IRS. It's coming out of the home.
Oh, okay.
It's not really getting them off your back, but it's having to pay them.
Yes.
Again, we all have, I've sold stock. Every year I have to pay a little bit because I've sold some stock now. Because of capital gains and all that funny stuff that I don't understand, but barely understand. So, but at the end of the year, I know that I owe a little bit of money. Well, if I sold a good amount of it, it would be much smarter for me in my life, in our household, to put a reverse mortgage on the home and then take the money out of the house because we needed it then, than to sell the stock and pay the taxes. That's really.
You guys, that's another strategy for even a home equity line of credit. Yes, you have to pay back a home equity line of credit. But the point here is money needs to move. If you've got equity sitting in your house, just sitting, and it makes you feel good. Knowing you have your house mostly paid for, I know that makes people feel great. Think about, I have money sitting here that's not doing anything, but making me feel good. Can it make me feel better by doing something for me? And it's something to really work through and really see how you can have your idle equity, your money that's just sitting, work for you to whatever degree you can stand and feel comfortable with letting it happen. Can you decide to take a reverse mortgage and say, I just only want 10% I only want to use 10% of my equity for a reverse mortgage? Can you do that?
You can. I probably recommend looking at a fixed because it's going to be the least amount of money you can take out. However, line of credit, you will only need 10% of the funds. You could let that line of credit grow. You don't have to use it if you don't need it.
Okay.
And
And
if
can you
you
take
don't
more
need
than,
it, it just stays as equity in the house to be sold later on.
say that again, I'm sorry.
If you don't use it, even though it's grown and it's grown greater than the house value, if you
Yeah.
don't use it, it just goes, it just stays in that. It's not part of the loan. So the loan is one bucket and the line of credit is the other bucket. They're both growing. The loan balance is growing. The line of credit is growing, but they do work separately. They're not joined.
Okay.
It's a lot to take in.
This is really, really interesting stuff. How do you find a reverse mortgage specialist? What questions do you need to ask? How do you know you've got somebody that's not scamming you? Because how do you find somebody that's really going to work with you? And one of the things you said is they're helping you see down the road. It's not just a matter of selling you a product, which is always a clue that you don't have the person you need. They just want to get you in this product. No. So go ahead and I'll let you say, it's like, if you're thinking about it, how do you find a person that can help you?
Well, I do. There's certifications out there, and I have mixed feelings about certifications. Basically, we pay money, take a test, and that says we're certified. Well, to some degree, that's a valid thing. I'm not going to, I think more than anything is to ask, how many reverse mortgages did you do? There, I'm seeing now that, I mean, I can do loans in Colorado. It doesn't matter. I actually do loans in more than one state. Well, I'll just use Colorado as the example. So in Colorado, I can do any kind of loan, even oddly enough, commercial, which I wouldn't even begin to know how to do. So I could help you buy a house with a forward mortgage, typical loan that we've already seen, or I could do a reverse mortgage. So the biggest question to say is, what's your percentage of purchases do you do? What's your percentage of forward loans versus reverse? And if they say, well, we farm that out, that might be okay, because if they're farming it out, they're farming it to somebody who really does do reverse mortgages.
Yeah.
I think that's going to be the biggest thing to ask. And if all they want to do is quote you a rate and they don't want to find out what your financial life is, just enough to get you qualified for the loan, they're not looking at, is there going to be enough assets if one of the spouses die? What happens if your Social Security goes down? Are you going to be able to make the payments? These are things that need to be considered. And if they're not, then I think I'd move on.
I think so many of us don't ask the questions, and I want to sit down and have conversations with people like I'm having with Laura. Let's have a cup of coffee. Let's talk. Let me get to know you. You get to know me. My financial people, to me, need to know what I'm looking to do. What do I want out of whatever I think I want? I've had financial folks just do what I tell them to do, and it's never worked out. I'm telling you, never worked out. When I say what I want to do and they get curious about the why, many times what I want to do is never going to get what I think I need, isn't going to get me what I want. Let me just put it that way, what I want. So have that conversation. If somebody's not asking you, and it shouldn't be you just spilling out the beans. If they need to be curious with you and get to understand what your goals are, what you're working to do, your why of doing it, so that you can get the best products for you. So
Absolutely.
we cannot be afraid to have these conversations, and we can't be afraid to say, no, this doesn't work. Even if you get somebody, you start working with somebody and you find out, ooh, I missed that. And let's look somewhere else. Do it. This is your money. Nobody cares about it more than you do.
Absolutely.
So have people working with you that you know, like, trust. And I'm going to do my analogy of our 401ks, how we put our money into our suitcase. Even though we never see the money, it just goes right in there. But if you think about it, if they gave it to you, what you're doing is putting it in a suitcase, handing it to a hand around the corner, and hoping they do something with it, that when you retire, it's going to come back to you.
Right.
It's the worst system ever. To me,
I can speak personally to it. Didn't work out.
Yeah,
I do now.
You are not the only person. We all think when we get ready to retire, our money's going to be there. The money I saved and didn't get to spend and didn't go on vacation. I worked until I could retire at whatever age the government says we'll be able to retire.
Right.
And now the money's gone, or it's not what I thought it was going to be.
Or it didn't grow.
It didn't grow like it was supposed to grow, or like I was told it was going to grow. We can go. Okay. How can people get in touch with you, Laura, if they want to just even, I mean, like, I'm not sure what questions they would have. You're in Colorado. What other states do you work in?
I actually do loans in Colorado, Florida, Arizona, and California currently.
Okay, well, that
So
covers a lot of people.
it does. But however, I will entertain anybody's calls.
Okay.
If I can't do the loan, I do have a referral source that I feel comfortable with. I have done it with a close friend's mother, and it worked out beautifully. So I will make sure that those get over and I hand it off, and it worked very, very well. I will send happily anybody who contacts to me a little bit of book. I wish I'd written this book, but I didn't.
Okay.
But it's a great book. It says how to put your home equity to work.
Perfect.
And it's a question and a one-page answer kind of thing. So it's really written in simple English. I highly recommend being educated. If you work with me directly, we have a conversation. I find out what it is you want to do, what you're hoping to do, what you heard about reverse mortgages is probably
Yeah.
not totally accurate. Let's get rid
Yeah.
of those misconceptions. After that, I put together a proposal, and then we talk about numbers. And that proposal, I might have been totally off. You're going to tell me how to fine tune it. Once we've established that, the client will go and take a class. It's a HUD certified class. It's a third party to make sure that the clients understand what this reverse mortgage is. It's for your protection to take the class. If somebody says, oh, you don't need to take the class, I would definitely get up and walk away. It's not the case. You do need to take the class. Start to finish, from class to end, is about 6 weeks. To do
Okay.
that, do the loan, and close on it.
Okay.
I've had people talk to me every year for the last 3 years, and we've not done the reverse yet. It's timing. And that timing is your timing, not mine, but yours.
So starting the education now, whether you're ready to do it or not, is one of the big keys. So that you even know what your options are when you're ready for something is above everything to me. Just to, that reverse mortgage thing. I saw that on Money with Mission podcast. Who is that woman? Everybody knows how to Google reverse mortgage, Money with Mission comes up. Laura's name is going to be there, and the show notes is going to be how to get in touch with her.
Absolutely.
And reach out just to start the process. Okay.
I fully believe education, start the process. And it is your timing, never mind. And if somebody says, oh, we need to close this right away, it's probably not the right person for you.
No, not if they're pushing. No.
It's for you. It is your money, and it needs to be your decision.
One of those things I learned is anybody pushing you to do something on their timeline is not the person for you to work with. It's like, no, I got to take some time to think about this and understand it and get to know you. Even if that's what's in your head and you don't want to tell them, it's like, no, I just need some time to think about this, and just walk away from something. Laura, this has been the best. I love this conversation. I've learned so much myself. I hope you guys have learned something. I really appreciate your time. And Laura's contact information will be in the show notes. So go there, because I know you guys are not just sitting there with a pen and pencil and a paper writing down everything. So it'll be there. And reach out, start your education on reverse mortgages. And even if you're not like, I don't think I'd ever do a reverse mortgage. To me, opening the door, opening your box. Remember, we talk about being in a box. Opening your box to learn something may send you down a path you never thought you would go down, just because you learned something about this. Laura may trigger something in your mind. It's like, oh, let me check that out. So learn everything you can about money. Talk about money every day. I'm serious, every day. Make it easy on yourself. It will be hard at first to talk about it because nobody talks about it, but let's get going, okay? Thank you so much. Thanks for listening. I'll talk to you next week.
You've been listening to Money with Mission. There are projects happening right now where you can have a great financial return while positively affecting the lives of others. To learn more about our opportunities, go to moneywithmission.com.